applies directly to all of you. This is why I included it. Home prices are down. Unsold homes are down. Housing starts are down. About the only good news is the average mortgage payment is at an all-time low for what it's been over the last 5 to 10 years. So, and what's so challenging about these slides is that the information we get on a quarterly basis, so this is based on 9/30, well, it's like by 10/5, 10/10, so much has already happened in the market, it's like old news. So in some of them, I have to do updates on them. So we have corporate growth that's as of 9/30, again, keeping in mind, September and October were two of the worst months we've seen on record. So this was as of 9/30. Productivity was down, profits were down about 29% as a whole for companies. We have after-tax corporate profits are down based on what we're seeing. We have our PE ratios, that's price to earning ratio. This is the S&P 500. We call this our W chart because it's like an upside down W right now. But I chose the values on 11/24, it was 851 for the S&P 500, just because I knew it changes so much every day. We're like off that by 10 today. So it's up, it's over that now for the S&P 500. And it was significantly below that after I ran this slide. But really what I want you to walk away from this slide with is the fact that price to earnings ratio talks about the valuation of the company. It's the price of the shares versus the actual value of the shares. And when the valuation is extremely high, like it was up here in March of 2000, where the PE ratio is like 30, it means you're paying a lot of money for that share that you're buying. Right now, we're looking at forward PE ratios at about 12. The historical average is about 17. So there's tremendous value out there now. Well, the thing is, this is September 30th numbers, that the PE ratios were 12. Now the ratios are down at 10.5 to 11. They're even lower than they were. So again, people will say, why should I put money in the plan if I know the next 3 months, 6 months are going to be negative months? We don't know when the market's going to turn around. It could turn around in 3 months. It could turn around in 6 months. We don't know. But if you're not in the market, for sure you can't participate when it starts to take off. And if you're putting money in the plan, it means you're buying at dramatically reduced values. So it's not a bad thing when you put money in the plan. Where it becomes extremely painful is when you're retired and you're having to sell shares to live off of, and you're selling them at a loss. That's painful because you can't make up for that. But if you're maximizing what you can put in the plan right now, this is not a bad time to have as much money going in the plan as possible, because you're going to be able to be rewarded when the market turns around. This is one of the slides that I have to update it as soon as it comes out, because as of 9/30, gas was running about $3.72 nationally, and it was going for about $100 a barrel. As of 11/24, it was $1.15 a gallon. It's now about $1.16 a gallon. A couple weeks later, the $54 a barrel is just over $50 a barrel in terms of what's happening. So this is great news for us. This means we have more disposable income. When we were at $147, $148 a barrel and gas was $4.50 to $5 a gallon, I mean, I can't tell you how much I saw traffic drop, how much I saw traffic on buses and the trains go up in terms of ridership, and people found a way to save. 10% of the population found a way to keep from driving in their cars. And that's what kind of started things turning around on the commodities front. So it's actually, it's amazing how much control we have, because as oil's escalating, and we had people talking about $300 barrel oil if there was war breaking out in the Middle East by year end. We're looking at $50 barrel oil right now. Now they're talking about next year anywhere from $75 to $85 a barrel for oil. That's very reasonable now relative to what we're used to seeing. And again, it means there's more money for us to be able to have disposable income to either increase what we're doing in our 401k or to be able to live in what we're doing. Now, this is a critical factor. Unemployment's on the rise. It was 6.1 as of 9/30. It's now 6.5%, and it's increasing. But what's happening is that if we break out certain sectors, for example, like construction locally, and we look at things like lumber mills, we look at things like home builders, it's actually higher than that. It's over 10% in terms of what's happening in unemployment. The average number of 6%, 6.5%, it's not bad nationally. When it hits double digits, that's where it really starts to get us. But because of the kind of the New Deal that President-elect Obama is talking about for 2009, he has a tremendous amount of infrastructure jobs that are lined up for improving what we're doing and putting people back to work. So there's millions of dollars that are going to be able to go out to those millions of individuals to be able to help them out that are now currently unemployed. So that will be a big help in what we're doing. Now, this is to give you a little hope, all right? Just to tell you that, you know, as dark as it is right now, we always pull out of this eventually. Probably the closest thing that resembles what we're in right now is the oil prices, 73, 74. They were down about 42%. The market's down about 45% right now. What happened is that 73, 74, they experienced this negative 42%. However, the next 2 years, 75, 76, it rose 57%. So again, if people chose to get out right here at the end of 74 and go to cash, they would have missed all of this increase in the market in terms of what was happening in the increased value of their funds. However, there is something that's very different about what we're in right now. This negative 42 occurred over 2 years. Our negative 43 to 45 has occurred in 1 year. And because of the projections for 2009 being lukewarm with single-digit growth, with the bull rally that should start hopefully third quarter of next year, that's going to cause us to be able to have a longer period of positive returns, but it could take longer to be able to make up the losses, meaning it could take 2009, 2010, 2011 before we make up to break even for this negative 43, 44, 45% that we're currently in. Because of that, we have to take this long-range view. Now, if you're getting ready to retire, if suddenly within the next year or two, you're saying, what am I going to do because the market's down? Well, we have to take a look at your asset allocation. We have to, hopefully you're not 100% in equities if you're going to be needing that money in 3 or 4 years. You've got an 80-20, 60-40 portfolio. You've got a higher bond percentage. We have to look at ways of maybe extending when you retire to be able to get you in a firm bull period. What happens is that you don't want to have to sell any funds that are running negative, because then you realize those losses. If you can defer using any money that's in the retirement plans that are down and use savings, use taxable accounts where you might have CDs, you might have some kind of bond components that you can sell to live off of, that's preferred over touching something that's negative, that's tax deferred. And again, I can work with each one of you if you have questions on the best way to be able to implement that. This is the VIX. This is really, it's a fear factor gauge. It's a volatility index. It's for options on the exchange market. Prior to 1024, we were looking at peaks of about 42, 43 in the VIX. We hit 89 on 1020. It just blew away. It doubled what the highest level was prior to that. And right now we've been running, the VIX has been running anywhere between 60 and 70. It just means there's a lot of fear. People don't know what to do. That's why we're seeing these huge 680-point run downs yesterday, and suddenly we have a couple hundred points where it's up today. They don't know. All it takes is a little bit of news. You know, what triggered the decline yesterday is the fact that we had a manufacturing sector report that showed that we were down. The big thing was officially, like no one knew this, officially we're in a recession, and it started December of 2007, and then we have an issue where credit's not freeing up the way that it's supposed to. So there's part of the good news in what's happening is that there's another $200 billion that's been assigned for bad debt in mortgages that's going to be freed up for local banks. Yes, Nelson?
They seem to be changing the rule on what a recession, you know.
Yes, it is. You're absolutely right. Technically, you need 2 negative GDP quarters. We have not had that yet. So it is interesting.
But
because
now they're saying it's a year old.
Right. They're saying it started in December, which is not a technical recession. But what they're saying is because of the reduction in labor, because labor has been declining rapidly since then, based on labor, it's a recession. And because of the extreme losses, everything's been compressed. Normally, you don't know you're in a recession until you're 6 months out of it. This is really one of the first times we've been in a recession and they acknowledged it. But also what it does, this becomes a very, very long recession, because typically recessions last 6 to 9 months, and you discover 6 months later that you're out of it. We're already at a year right now in December, and we're looking possibly at another 3 months, 4 months of going the same way with labor and unemployment until we have a new president and we can get these programs implemented before it's going to turn around. So I think